So, you have a business idea ready to go. Now you need to find the right funding. But where do you start? Well, that's what I'm going to show you. Hi, I'm Myssy, founder and director of Myssy & Co., a professional services firm based in Sydney. I've been involved in accounting, business advisory and tax for nearly 25 years, and I'm passionate about making high quality advice accessible to owners and teams of all sizes. Welcome to another part of our Savvy Business Owner's Guide to Financial Success series, which is designed to help you navigate the complex world of business. Whether you're starting a small business or expanding an existing company, you'll need the funds to do it. You might already have enough stored away, but in many cases, you'll need to access some kind of business funding. Financing a new business venture is no doubt a challenging process because you need to understand when debt is an appropriate funding source for growing your business, what type of funding is best suited to your financial circumstances, and what stage your business's growth is at in relation to the different funding pathways. So, in today's video, I want to tackle all things business finance, including the different types of financing available for Australian businesses, when to consider financing in your business, and the impact of business structures on financing options. But before I do, let me clarify that this video shouldn't be considered financial advice and should rather be interpreted as general information. We always recommend that you seek tailored professional guidance to ensure that it takes into your account your personal circumstances, objectives, and needs. So let's start at when you might need to look into different financing options. The first option would be when you need working capital to get the business up and running and cover costs like web development, design, desk space, and even hiring some early employees. It will basically carry the company out of an embryonic or foundation stage. At this stage, you might also want to take out a business loan to build your credit profile and establish a relationship with a bank in anticipation of future borrowings. A small overdraft or business credit card is a simple way to do this. Another instance where you may want to consider financing is to pay yourself a proper salary. I know it may sound strange to borrow from a bank to pay your salary, but earning a salary means you can diversify your assets and wealth outside the business. And the last two instances would be if you didn't want to give away equity in your business or if you wanted funding to purchase another business. Now, let's look at the different types of financing available. Your first option is a founder loan. A founder loan is essentially you putting your own money into your business to cover the initial startup capital. The benefit of injecting your own capital into the business is that it is often seen as a sign of your commitment to the business to future investors and partners. And if you don't have the capital to invest, you might want to consider a family loan. It would work the same as a founder loan, you're just borrowing funds from a family member. Both options are typically ad hoc, informal, and don't involve security. Next up, you have bank finance. This is where you borrow money from a bank to fund your business. Most of the time, banks will want you to provide some kind of security for your business loan. And usually they'll want the security to be property backed. If you already have a business set up and you're making around $2 to $3 million net profit annually, you can access cash flow financing if your business is generally strong and stable. And the rate is similar to property backed loans. For businesses generating smaller profits, cash flow financing is still an option that can involve higher rates of interest. If you don't want to go the traditional route of approaching a banking institution, you could also look into non-bank private lenders as an option. Generally, private lenders can offer short-term or bridging loans with terms from 1 month up to 36 months. But the only thing with going the private lending route is that you're likely to pay higher interest rates. Generally, they'll offer you a loan with an interest rate between 5 and 12% where they are taking a first mortgage, and between 12 and 24% where they are taking a second mortgage. Just like banks, private lenders usually require you to provide property for security. In very rare circumstances, some might even accept security over the business. And then the last option is to raise capital. Raising capital means obtaining money from investors, venture capitalists, or other sources to fund your business. Although initially it may be structured as such, this is not a loan. So essentially, you'll be giving away equity and reducing your ownership in your business to raise funds. Raising capital can also be quite expensive because you'll need to pay legal and advisory fees, and there could be initial and ongoing reporting obligations. Those are a few of the financing options you have available. However, it's also worth considering that depending on the structure of your business, some finance options will be easier to access or more suitable for your business. For example, for companies or trusts with corporate trustees, the director's credit history could impact the business's ability to borrow. So if they have a poor credit history, it might be more difficult to get business financing. Here's where speaking to a business accountant will be in your favor, because they generally have an extensive network to access a range of options that works for your business structure. Now, let's look into the difference between good debt and bad debt. Many businesses are uncomfortable with the idea of financing because they feel that all debt is bad debt. However, not all debt is bad. Good debt is a type of debt that supports your business growth and ability to create wealth through investments. Conversely, bad debt does not do this and is typically associated with transactions of a private nature. As a general rule of thumb, good debt generates more value or money than the loan itself costs. For example, your business could borrow money to buy an asset that generates income for the business, and the return on investment for the asset exceeds its after-tax interest cost. Good debt also forces business owners to be more disciplined with their cash flow, as monthly obligations need to be met. It can help a business stay lean and not incur unnecessary expenses. It is common to see owners injecting personal funds into their businesses. This may be because they believe that this injection is only needed temporarily whilst the business generates adequate cash flow. Or it may be because the business owners are hesitant as it is perceived to be an increase in their debt position, especially where they have external debt such as a home loan on their main residence. Whatever the case, using private funds to inject into their business is taking away from their ability to pay down private debt. It therefore just reallocates debt from deductible business or investment debt to non-deductible private debt. The overall debt position actually doesn't change, and they are inadvertently costing themselves more in tax and interest by undertaking this practice. That's a key feature of bad debt. If you're wanting to learn more about building your path to financial success, make sure to check out some of the other lessons in this series that cover a range of topics including accounting processes, superannuation, and property investment and tax. Alternatively, please do get in touch with our office to organise a time to speak with the Myssy & Co advisory team about the best path forward for you and your business. Lastly, if you know any business owners who need to hear this, make sure you share this lesson with them. Thanks for watching.